Good morning, this is Ken Long from Tortoise Capital with a review of the weekend trading report for May 25th, 2014, Memorial Day edition. We have a market that's in bullish normal conditions. On an annual basis, using weekly RSI 14, it's 66 out of 100, so at the high end of neutral. On a 10-day basis, it closed strong, and on the 10-day NDX has a score of 97 out of 100, putting it into overbought. Looking at the market mosaic, price with respect to the 200-day moving average at 6.82% is yellow bullish. Gives us almost a 5% cushion to sideways markets. Slope of the 50 is also yellow and neutral at 0.002. ADX 14 at 9.2 is extremely weak for trendingness, and so a intermediate term trend can certainly develop in either direction from this condition of we've been basically choppy for 50 days. ATR percentage is normal at 0.80%. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. That reading today is 1.1, so we're in risk-on conditions, meaning that favorable results come from owning riskier assets for aim towards growth. If you take that score of 1.10 and compare it to the last 5,000 trading days and find the Z-score, we're at a Z-score of 0.89. You can see the last 90 days of this indicator shown as a histogram here. And after this pause, we have now moved up to the critical one, almost to the 1.0 state, where rolling over would be normal, which could lead to an onset of a volatility event here, in view of the fact we've been improving the volatility posture for almost 3 weeks. Blended monthly rebalancing is going to hit at the end of this next week. The current holdings are shown for ETF 13, 22, and 32. The current holdings, based on the current reading of the database, are shown. You see a shift to riskier assets here with Latin America emerging markets in ETF 13 and 22 and 32, with Brazil joining the mix in ETF 32. In ETF 2, the theoretical exposure of the model is at 90%. The model portfolio is also going to be at 90%. It adds a position in India this week. Just a quick look at those blended monthly rebalancing stats. Only U.S. small caps are on a cash signal. Really been lagging the rest of the market. There is some evidence that they are in a posture to make a nice 10% run up to the swing high. If we shift back over deeper into risk-on assets, their small caps got room to grow. The Dow and the S&P large caps have been outperforming the small caps, and so they're breaking out to new highs on Friday, all-time highs. And so if the rest of the U.S. market wants to play catch-up, the small caps have some room to go. And so that kind of a strong, sharp move wouldn't surprise me. In ETF 32, only the Russell and gold are on cash signals, and you can see the strength moving to the overseas risk-on candidates, with Brazil, Latin America, and emerging markets really dominating here. You can see what kind of a nice move Brazil and Latin America have had off the bottom, sort of a proof of principle of our washout patterns. In the ETF Max, dominated by India in every category, then commodities with agriculture. Turkey remains near the top with a recent score of 29% on 3-month and only 6.5% on 6-month. So that is a relatively early stage growth. So we should be looking at that. And base metals has some possibilities for XLB and promises for Alcoa as well. You can see the strength coming out of coffee now. That is white and then green. It's had its nice run and fully priced. S&P 500, this basically just shows the ranking of the S&P 500 on the blended monthly rebalancing, and also shows the sector that they are in. Forest Labs should be of interest because it's negative on the 3-month and has been up 90% on the 6-month. That's a result of a great big gap up. On the other hand, Lorillard and CenturyLink ought to be of interest with their recent strength on 3 months and only average, slightly above average on the 6 months. So there could be room for them to grow. Some extraordinary moves available in the S&P 500. As you can see, this is a reason why we want to pay attention to the strong sectors and the strong performers in those sectors. Looking at the market health check, you can see we broke out to an all-time new high on Friday in the S&P. These vertical blue lines excuse me, represent 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that have held in the past, but which also act as price targets on the way down if they fail. The horizontal purple line represents that previous swing high that we just eclipsed on Friday. That puts us into the green zone when my intuition is that I want to be long by default, both intraday and on swing. When we're in the yellow zone, I like to be long, but on the swing trades, but intraday I will take the direction that the market gives me for intraday trading. But in the green zone, my default is to stay long, to look for opportunities to get long quickly, based on a continuation of trend. Now that we've cleared this previous swing, this is like a triple top that we finally broke through, and we're off and running in the S&P. Get 3 RAF regression channels displayed here. Blue is the short-term 10 period, black is the 30 period lagged by a day, and green is a 90 period regression line, the long range trend, and all pointing up, all looking favorable. Still have 5% protection against the sideways markets down here around the 200. Jaws of PPO are really closed shut because of how choppy this market has been now for almost 60 days. You can see here, compared to 60 days ago, we've mostly just chopped around. We're currently overbought. You can see how low the ADX is. No follow-through trends, although this one does show some promise. ETF2 regional report. 9 out of the 10 sectors are above their 4-month moving average, so they're on buy signals. That puts us at 90% invested, 10% cash in the theoretical model. The S&P at 64, slightly better than EFA at 63, so it's the U.S. over the world. Inside the U.S., it's large caps, mid caps, tech, and then small, so small caps have some room to catch up. 2 strongest sectors, emerging markets in Latin America. Latin America at 67, emerging markets at 66. The 2 weakest, U.S. small caps, and then Japan. Strength returning to the S&P sectors. Healthcare and discretionary, and financials lagging. Energy is ascendant right now. World market model still Dow and the S&P are above average. Everything else in the U.S. generally below average. You can see strength is to the up and the left, and the small caps are weak. Latin American emerging markets above average. Brazil still dominating. Japan below average. Asia less. Japan above average. China lagging. India, Philippines, and Indonesia really strong, and all the rest of the Asian countries have turned the corner. Starting to see some laggards in Europe now. Basically parity between the U.S. and the global business sectors, with a slight hat tip going to the U.S. Top 30 ETFs using the ETF2 database. Those that are green on strength and white on consistency are of interest, so Turkey and Colombia still remain of interest, as is Brazil. The Dow 30 have only two in the green, Caterpillar and Cisco. JP Morgan and Pfizer at the bottom of the stack. Those that are green and white, so Cisco is of interest. That's their more recent arrival at the top. Disney starting to lag a little bit because it's white and green, as are Microsoft and Merck. And liquidity stats based on average daily dollar volume over the last 30 days. Those that are in green are exceptionally liquid, therefore tradable intraday. Shifting to the daily. No signals in channeling and overreaction among the indexes. We do have some signals in here for channeling among the extended ETFs with real estate and agriculture, and then the large caps, AT&T, Walmart, IBM, and Coke. Triple screens for real estate, discretionary in Brazil, and ExxonMobil. Looking at the Dow 30 tactical summary, got half a dozen that test out better than 2-to-1 on the auto framer, with Walmart being especially of interest. It's a channeling and overreaction, a max pain. It's number 2 on the max pain range compression. Has 4.4-to-1 on the auto framer. Very froggy with a frog quality number of 3.1 and tests out at 2 on the RSI 2. So that's a good posture. ExxonMobil in the energy sector ought to have our attention. Energy has been excellent, and this has been a strong one, and it comes in, though, on a triple screen. So we may have created an investable moment. Among the ETF 30, half a dozen on doji signals. Got a couple on channeling here with real estate and agriculture. The VIX coming in at 6.4-to-1 on the max pain range compression. Got triple screens here in real estate, staples, and Brazil. So Brazil should be of interest to us. In the auto framer, Walmart leading the way at 8.5-to-1. That would be using a 42 cent risk, which is the range risk plus a buffer. Has an ATR of 0.82, so that would represent like half an ATR initial stop. But still quite a few good names to choose from in here. Cliff is on my short list as a preferred trading target. And the rest of the charts for reference purposes. This is real lagging right here in CLF. And you can see the strength in emerging markets here. Looking at the z-scores of the regression line slopes, I like this posture for a resumption of the upward trend. We've had a divergence to the upside in the 10 period, and it has come back to its own 6-month mean. The 30, after this nice dip, is now making its move back up. It is not yet into extreme conditions, being within plus or minus 1. And then the 90 has calmed nicely, but has maintained its bullish orientation above the 6-month mean and is starting to improve here. So that all looks good. It's been a quiet market. It has failed to fail after this last little spike down. And so the nearest neighbor of that is this move, which went from 170 to 183, so a 13-point move off the low when it cleared. So this could get us up to 195, 198 in the S&P pretty nicely. And that's the weekend report from Tortoise Capital. Take good care. Think about your soldiers and sailors out there, Marines and Air Force on the freedom's frontier, and give some thought to them and their families. So thanks for your kind attention. Keep your risk measured and your powder dry.